An initial public offering, IPO, is the process by which a privately held company raises capital by selling shares of stock to the public for the first time. The company issues shares to the public through an underwriting firm, which acts as an intermediary between the company and the investors. During an IPO, a company will typically hire investment banks to help them price and market the stock offering. This includes determining the number of shares to be sold, the price per share, and the overall valuation of the company. The company will also prepare a prospectus, which is a document that provides information about the company's financial condition, business model, and management team to potential investors. This document is filed with the Securities and Exchange Commission, SEC, and is used to comply with securities regulations. Once the prospectus is approved by the SEC, the company can begin to market the stock offering to potential investors. The investors can then decide to purchase shares in the company. The proceeds from the sale of shares in an IPO are used by the company for general corporate purposes such as expanding the business, reducing debt, and providing a return on investment for early investors. The IPO process can be a significant event for a company, as it marks the transition from a privately held company to a publicly traded one. It can provide a significant amount of capital for the company and increase its visibility, but it also brings added scrutiny and regulatory compliance requirements.